The opinions expressed on Two-Way Traffic are those of Darren Coleman and are for general information purposes only. It does not constitute any legally binding engagement between the podcasters and anyone else. Always check with your advisors to obtain your own tax or investment advice. Welcome to Two-Way Traffic with Darren Coleman of Portage Cross-Border Wealth Management. In this series, Darren aims to guide you through the complexities, complications, implications, and most importantly, the advantages of having money and family on both sides of the border. On this episode, Darren is joined by Shlomi Levy of Levy Salas LLP. They'll discuss the what-if nightmare when Canadians buy U.S. property.
Hi, everyone, and welcome back to another episode of Two-Way Traffic, the cross-border podcast with Darren Coleman. And today I'm delighted to be joined by my good friend, Shlomi Levy, who's the principal and founder of Levy Salas LLP with offices in Montreal, Toronto, and Florida. And today you join me from your Montreal office, which is close to home. So welcome, Shlomi. Nice to see you.
Thank you, Darren. Great to be here again.
So you are a bit of a unicorn. We know attorneys that focus on Canadian tax issues, and whether it's buying real estate or employment or other tax things. We know people that do U.S. only. There's a remarkably small people, like on one hand, I can count how many I think we know, that do both Canada and U.S. together, that do that level of planning, because we've got U.S. taxation, Canadian taxation, and then all the stuff that falls between the cracks. So you really are the specialist in doing this. So you and I have had a chance to get to know each other over the last few years as you've developed this specialty. So we're going to zero in today on one area where a lot of people encounter problems that they may not have expected. And that says Canadians buying U.S. real estate. So this is an area where I know you've got a lot of expertise, and we've asked you to work with a number of our clients when they've got the more complicated files and situations. So I'm going to play a little dumb today, not a stretch. And I just want to go over what some people would be thinking about when they're going to be buying a property. And we're right now in the middle of winter in Canada. So not a surprise that people maybe want to get out of here. I've always argued that Canadians may like global warming. That's why we like wearing shorts in Florida and Arizona. Don't start sending me bad letters because of that joke. But why don't we begin with, now, by the way, before we set up maybe a couple hypotheticals, does it make a difference if we say Arizona or Florida, or can I just generically assume they're all the same?
Well, you could definitely speak about the Sun Belt states as kind of the place where Canadians want to be. California, Arizona, some Canadians with an intuition for gambling, like Nevada. Florida is very popular. So yes, I think that the general concepts that affect Canadians purchasing in the U.S. will be similar in impact. However, the nuances from state to state differ, but I mean, the general concept will work on across the board.
Okay, good. I just wanted to set the table like that because we're going to have to talk in generalities, but for every individual person, the specifics of their situation will require, some one-on-one advice. And we do appreciate that California, Florida, they're all a little bit different, but today we'll just kind of go top down and say, what are the large things people need to worry about? So why don't we begin with thinking about someone in Canada says, I'd like to acquire a property in the US, and how would I buy it? So maybe the first thing is, if I want to buy it just in my name, is there anything I need to be mindful of? That seems pretty straightforward. Darren wants to buy a property in Florida. Darren buys a property, puts it in my name. Anything else I should think about, or is that pretty simple?
Well, let's start by stating the obvious, that each fact pattern is unique and distinct. So stuff that we may discuss today may not apply to the next person listening to this podcast, because they may have a twist or a fact that is different than yours. So it's important to take this for what it's worth. Make sure that you push the envelope on the fact pattern so that the audience gets what they feel they need out of this. The other thing I want to say, just following your introduction, is there are fantastic Canadian tax attorneys that know a lot about how the system works on the U.S. There is a ton of fantastic U.S. attorneys that know how the U.S. works. The difficulty is getting them to speak, and the duplicity of professionals in your file. And where our practice is unique, and my particular practice is unique, is the ability to understand the U.S. system, understand the Canadian system, and provide for a third kind of silo, which is the cross-border system that I like to call, which is it's a different field. You want to be able to give advice to clients after weighing in the impacts of the Canadian system and the U.S. system to create that third silo. So I like to see it as a completely different expertise, as opposed to being a tax expert or specialist on one side or the other. But there are many things when people, and the reason we're talking about real estate is typically for Canadians, unless you're a youngster that's looking for a new job, the first kind of entry point for Canadians is real estate in the U.S., most of the time in any event. And so the reason we're talking about that is that. Now, obviously, there's a gamut of issues that you want to consider when you're buying real estate, whether it's in Canada or in the U.S., but the degree of difficulty kind of accentuates when you go down to the U.S. So you mentioned Darren hates the cold, likes the heat, wants to go down to Florida, and as you said, it's minus a gazillion here in Canada. Hasn't been very nice in Florida this year, but still better than here. And typically what you end up having is an emotional purchase. So somebody walks in, rents an Airbnb in a building, likes the vibe, and next thing you know, he's under contract, right? That's besides those who go to Orlando and, for a free ticket to the park, buy a timeshare.
Oh,
right?
yeah. We won't. Yeah, that actually, we may do a whole separate one about timeshares later and how they're kind of a one-way street. You can get in, but or Hotel California, you can get in, but you can never leave, right?
That's right. And so, one of the main things that families will worry about when they purchase in their names is, okay, well, what happens next? What happens if I become incapacitated? What happens if the owner passes away? Then you start thinking about, well, what would my usage be, right? Darren, you're like 34, right? You have time to spend 6 months.
You aged me there. Yeah. I mean, I started doing this job when I was 3, so it's been a long time.
I have to give the audience your real age, right?
Skincare regime is everything.
So, young families, not really worried about that question, but you need to ask it. Then the next question is your age. You're probably not necessarily a full-time snowbird. You're probably not necessarily using it for 6 months. Do I want to pay all these costs and keep the door closed for 10 out of 12 months? Or do we want to go into rental? So that's okay. Well, that's a second consideration. I'm going to rent it out. What do I do? What do I need to worry about when I'm renting it out? Then the third consideration within that rental is, well, is it short-term rental? Is it long-term rental? Do I want to take advantage of the Airbnb, short-term, one night, 1 week kind of rental programs? Or I'd like to find a good family that will take care of the house, like if it was
and every season I get the same people back.
People back, and then then what are my tax questions? What is my tax liability? Am I taxable on that income in Canada? Am I taxable on that income in the U.S.? What type of tax regimes do I have to look into? Is it income tax? Is it capital gains tax? Is it death tax in Canada or the deemed disposition? Am I going to have to worry about U.S. estate tax, right? And then as you start going down the ladder of these questions, the liability questions becomes very, very important, right? We always joke about U.S. being litigious. You and I are from that generation that remembers the Seinfeld episode with the hot coffee and the $10 million award, right? So, right, that's the U.S. for you. So are we worried about that? What are we trying to protect?
And by the way, you didn't even get into the financing of it. Like, how do I pay for it? Do I have a mortgage here? Right? Do I take a mortgage there? That's a whole bunch of other considerations that go into how do I pay for it.
But it's all that trickle down effect, right? If I'm going to put it up for rent, well, the likelihood is I may want to have some financing on it because I'm going to be able to, utilize income to pay for the debt. Then you go into the exchange rate, right? Well, if I'm going to borrow, then I don't have to really worry about the exchange rate. The U.S. bank will typically give me $1 in USD. I don't have to worry about 35 or 36% exchange, right? Then we want to say, okay, well, now I have the income, but I've got the debt, but I want to write off the interest rate, right? So a lot of people that are going to get into that game will make the very tough mistake of saying, well, my bank in Canada will lend me the money in USD. great, fantastic, but you're still considered to be a cash buyer in the US. You don't get the deductibility of interest on the US side. You only get it in Canada. And since you're going to first get taxed in the US, so all these questions, they just become apparent as we start discussing the property. But like I said, most of the time it's emotional. And so we get a client to call us. I bought. Okay.
You've already met with the realtor, you met with the timeshare person, and you're all signed up, ready to go. Now what do I do? And it's like, now it's a bit late, right?
Yeah, that's right. It is and it isn't. So there's obviously various questions to ask and various options that were or not checked off in the offer. And then we work backwards, right? So obviously, if there's a message to send everybody today, is if you're thinking of buying, please consult with somebody in advance. Know what you're getting yourself into. Kind of be prepared. If you're going to want to finance, then, sellers in the U.S. today are not excited about having a contingency, financing contingency, and then an appraisal contingency. So they prefer a cash buyer, or at the very least, somebody who already is approved. Mm-hmm. So, lining your ducks, right, to get pre-approved, to know the structure, to know your usage. And the fun part is discussing it with guys like you and me is we'll kind of open the horizon to the buyers.
Right.
Maybe they thought, I'm just going to buy it for myself, but then, but if I can refinance or finance and I could rent, and the tax situation isn't so critical because I'm going to be prepared, well, maybe I'll put it up for rent. And then it opens up new doors and new opportunities. And suddenly that $600,000 or $700,000 condo becomes $1 million condo because we can afford more, right?
Yeah.
And I think that the intake for me, just like it is in your practice, Darren, is critical into understanding what goes into the decision of saying, yeah, buy it in your name or buy it with your spouse, or some will come and say, well, I'll buy it with my kids.
I was going to say that's one that we also encounter, right? So we're going to talk a bit about that. So one of the things that we also encounter, so you're exactly right. When someone's looking to buy, there's a whole lot of prep work that we'd like to be involved with them before they go buy. So they're a much more knowledgeable consumer, and we take some of the emotion out of it a little bit. But one of the things we also encounter, people who have had property for a long time, and I'll pick on Florida as our maybe sample case. And you have I'll just say very stereotypical. We have a husband and wife. They bought the property a decade or so ago. They own it in joint names, and now they're getting a bit older. And now we might have some issues around capacity, health, other issues. Are there things that can be, or people, again, need to be mindful of if they own that property, the family's had it for a long time, mom and dad own it together? Is it pretty easy? Is it or is it a problem if one of them starts to lose some capacity, or any planning they need to be thinking about specifically for some of those jurisdictions?
Yeah. So obviously, life gets in the way, and it is what it is, right? People bought it in their 50s and suddenly they wake up and they're 75 and they got to worry about these things. Healthcare, travel insurance is becoming more expensive. It's harder on the body. You end up going to Florida and you hit a winter like we've had this year, where it's gray and muggy and miserable and relatively cool. And now you're second guessing your decision to continue to spend these tens of thousands of dollars every year. So obviously there's questions. I want to say something about the U.S. in general when it comes to ownership in one's name, is that there's something very interesting on the U.S. side known as joint tenancy. So people could buy property together, whether they're husband and wife or parents and kids or siblings or just two partners. And in order to kind of avoid the issue on first to die, you've got tenancy opportunities. So husband and wife would live together under what is known in Florida as tenancy by the entireties, where the fact that husband and wife own it together, on the first passing, the surviving spouse automatically becomes the owner. So that's interesting, right? Then some people will go as husband and wife or as siblings or as partners, and you have a joint tenancy with right of survivorship, which does exactly the same thing. One dies, the other one becomes automatically the owner. So knowing that relieves one of a lot of pressure. But that's not always sufficient, because the next question from a smart guy like you is, well, what happens on second to die?
Yeah.
Right? We got a problem. We don't have a surviving spouse or a survivor partner. So we got a
It goes
problem.
into an estate of some kind, right?
It goes into probate, right? So
Yeah.
most Canadians outside of Quebec know what probate is. It's a dual kind of process of filing your will into the court records and having the estate settled pursuant to that will. In Ontario, in Alberta, in most provinces, probate is rather quick, a few months, 2, 3 months, 4 months, depending on the jurisdiction, and cost very little. In Ontario, we're talking about 1.5%. Some jurisdictions don't have a percentage, it's just legal fees. Then you hit the US. And depending on the state you're in, it could get very tricky, very time consuming, and very, very expensive. We look at states like Florida. Florida has a statute, a probate statute, and that statute also has a tariff that says how much professionals can charge to settle the estate. And it's a scaling process, but like probate on the first million of probatable assets in Florida, an attorney could charge 3%. So if you got a $2 million home in Florida, well, that's $60,000 minimum for the settlement of the estate. And depending on which county you're in, then it varies from anywhere from 6 to 24 months, and during which time all these assets are frozen. So probate is avoided on first to die when you have the mechanisms, but it's not on second to die. Now, if you take the scenario where maybe mom and dad owned it, they went through probate, now the kids inherited, now you've got two sisters owning the condo, well, you can't have a right of survivorship because she wants her kids to benefit and the brother wants his kids to benefit. So now you might have probate on first to die. But here's something interesting. Although we have rights of survivorships, what isn't covered by the right of survivorship is incapacity.
Right. So this is what I was getting at, is that we've got issues around when they're dead, it's complicated, but what if they're not gone? They just can't attend to things.
Well, that's it. And I've been doing this long enough that I've seen people's longevity grow, right? So we have more and more people living to well into their 90s.
Yep.
And they're physically fine, but they don't have capacity. They don't maintain capacity, whether it's a disease like Alzheimer's and dementia, or other diseases that affect their neurological performances. But we see more and more people growing old. And that says, well, they're not dead, so we can't settle the estate.
That's right. I think that's an important consideration for people, is that they think, well, I have a will, I'm good. I'm like, well, that only works when you're gone. And there may be a long period of time where you're around, you're breathing, but you're not allowed to settle anything. You're not allowed to sign anything. And you may have good days, bad days, but that becomes a problem. So having these other set of documents that deal with incapacity, in some cases for families, is even more critical.
Yeah. And the difficulty is, when we're talking again, secondary home, vacation, Florida, let's say that the husband is demented or is dealing with some sort of an incapacitated situation. Well, he needs care, right? So he stays in Canada. His wife stays in Canada. The kids stay in Canada. Suddenly you realize, I got this massive $2 million property that we can't even visit. Right. Well, what's the next decision, right? The next decision is we don't want to upkeep it anymore. So you want to rent it or you want to sell it. Well, guess what? The owner on record can't sign off. And so we're stuck. Now, so a lot of people are going to ask you, well, is my Canadian power of attorney valid in the U.S.? People ask all the time a question whether or not their Canadian will is valid in the U.S. So here's a kind of a myth buster. Canadian wills are valid in the U.S. In fact, the law says that if it was validly executed and it's valid in the jurisdiction where you've executed it, then it will be valid in the U.S. with respect to its creation and content. But it will still be subject to the rules of the land. So if you've got a Quebec will, which in theory is exempt from probate, well, that will is valid in Florida, but it's subject to Florida probate. Now, when we go into power of attorneys, because the U.S. in general in the real estate game is generally focused around title insurance, then what happens is most underwriters are not comfortable with foreign power of attorneys.
Right.
There's jurisdictional concerns, there's execution concerns, and typically they don't want foreign jurisdiction POAs to come and manage the sale process of a $2 million property. Because remember, you have to homologate people. When somebody becomes incapacitated, the homologation or the cleaning up of the situation has to happen in his domicile state or province. So it's got to happen in Ontario first before you take it to. So now underwriters don't want to rely on foreign courts. It's all U.S. And so it becomes very tricky. You think you're good, and then you're not. And now you got to do a legal procedure to get guardianship status over the property or over the individual. And that costs time and money.
Yeah.
You know? And so, and the biggest part is just the aggravation of going through it all when you're dealing with a loved one that needs all the attention.
I was just going to say, the time when all this bureaucracy hits people and they realize how complicated it is happens right when they have really limited ability to even cope with it, because you're dealing with a loved one who's going through their challenges, right? So this is an area where I think for families, we think about buying property. It's really important to get good counsel to buy it well and buy it correctly, according to your situation. But for families that have property, what we experience is the most people may not have most of this stuff attended to properly. So having a review so they're aware of this complexity and can begin putting processes and things in place to deal with it. So in the interest of time, I want to jump to maybe two areas where people look at other structures besides owning them personally that may be considered in part of their consideration. So
but before we do that, just speaking about wills and POAs, etc., I would say that if the only thing you've got mental runway to do is at least get specific power of attorneys and wills done for the state where you're going to be,
where the property is,
right?
Yeah,
and we call those situs documents. And we wanted to make sure of one thing, however, and beware. You want to make sure that whatever you're drafting is specific to that area, to that state, but more importantly, does not come and revoke your domestic.
We've seen that mistake because usually the first thing in the boilerplate is I revoke all my other stuff. And people don't think that, whoa, hang on, that's not what I'm intending to do here.
That's right. We just want, it's add-ons, right? So at the very least, if you're not going to do more, make sure you've got at least proper documentation for the state and not one that gets to revoke what you've done or gets revoked but what you're going to do subsequently. Does it need to be standalone? Once you do that, at least you've got some comfort level that, God forbid, should the worst happen, we have room to maneuver. Of course, as you mentioned a few minutes ago, the likelihood is none of that happens. We only wake up when, unfortunately, something does happen. So getting the ability to plan before is great, and going into your kind of your lead into a scenario. Well, husband and wife bought a property together. They're getting up there in age. Property was bought for peanuts in the 1990s. It's now worth 10 times that amount, if not more. What do? Do we do an Ontario set of documents? Do we do a Florida set of documents? Do we do a specific? Do we do, cross-border? These are the big questions. So a lot of people are going to go meet with a realtor. They're going to meet with a lawyer, and the local lawyer will give them great advice on the U.S. stuff. There's no doubt in my mind.
I was going to say it may be great for a Florida resident. And this is an area where we encounter this too, is someone will say, look, I bought a property. I was talking, there's a nice family from Michigan. We see them every season when we go down. They've got an LLC structure. So they own their property. And I think that's a great idea. So we went to the person that set it up for them. They're 2 blocks away from us in Orlando or Fort Lauderdale. And we did the same thing. Now, that big red flag for us, but why is that a problem? Why is it that structure that might be wonderful and very common for an American person is a problem for a Canadian?
Yeah. So let's maybe backtrack for a second and say that what does work for Americans doesn't necessarily work for Canadians. From a structuring perspective, from a taxation perspective, there are 2 sets of rules in the U.S., one for U.S. taxpayers and one for foreign owners, just like we have that in Canada. So what works for an American doesn't necessarily work for a Canadian. The difficulty is, go challenge a U.S. tax attorney or real estate attorney, and I'm wondering why he didn't give you cross-border or Canadian tax advice. And not everybody's got that intake process that we have to ask all the difficult questions. To be more specific on your example, we hear this all the time. Yeah, we were sitting by the pool in a clubhouse, and my buddy heard about our situation and recommended his friend or the guy who did his paper. We went to see him, and 2 days later we're set up and we're so thrilled. It's like, oh, okay, well, not quite.
Yeah, we set up this corp because we do a bit of Airbnb, or I rent to my cousin. Right. It goes in there. I get all these tax savings. It's wonderful.
Yeah. Right.
No.
And so, the big issue for Canadians and LLCs, and not to complicate things too much, but it's double taxation. So LLCs in the U.S. are known as disregarded legal entities for tax purposes, but they provide this nice shell against liability and against creditors and so on and so forth. But unfortunately, Canada doesn't have the equivalent of an LLC. And so where in the U.S., when an LLC generates income or generates a capital gains, the income or capital gain flows through to the individual member, and the individual pays U.S. individual taxes. Canada says an LLC, in our opinion, looks like a corporation, acts like a corporation, and typically smells like a corporation.
Right.
So we'll consider it a corporation. And since you are deemed to have received the distribution because the flow through on the U.S. side, Canada will consider any distribution from an LLC not income, but rather as a dividend from a foreign affiliate. And there's a very interesting tax treaty between Canada and the U.S., probably the best tax treaty that's out there in the world. And the treaty says, we'll do anything and everything that we can do to avoid double taxation on our subjects.
Yeah, so if I earned $1 in the United States, Canada says, well, if the U.S. taxed you on it, we won't tax you on it. We'll give you a credit on that tax that you paid, and it's all good.
But there are guidelines. The guidelines are there needs to be a match on the taxation type, the year of taxation, and the taxpayer. And so where Darren makes $1 in the U.S., and the U.S. says, okay, we'll tax it at 25%, and then Darren comes back to Canada, and because he's so successful, he's taxed at 53%. And Canada says, we'll tax you another 50%. We want to tax you at 53%. Darren will say, well, based on the treaty, since it's in 2023, and since it's income on both sides of the border, and since it's Darren paying the tax on both sides, I owe Ontario 53%, but I've paid 25% to Florida, or to the U.S., so I'm just going to pay the difference, another 28% to Ontario, and with foreign tax credits, we got a grand total.
Yes.
Well, when we have an LLC that says Darren paid the tax in the U.S., and he paid income tax or capital gains, and we come back to the U.S. and we says, oh, no, Darren did pay tax, but because it's a dividend from a foreign affiliate, he paid a dividend tax. We have a mismatch in the type of tax.
And that's the problem, right? Is that the way you paid the taxation in the United States, there's now a mismatch with how Canada perceives it. Correct. And both pay tax and there's no offset, right? And this is where we try to explain to people, it's like you set that structure up thinking it was a benefit. You may now have a 70 or 80% tax rate on any income by the time we roll through your Canadian side. So this was a great idea for your friend from Michigan or from Toledo. Terrible idea for you as a Canadian.
Yeah, and the reason being the friend doesn't have to contend with a deemed dividend from a foreign affiliate in Canada.
Exactly. Yeah, so be careful who your friends are. Now, the other, and we don't have a ton of time. You may and I may do a separate talk about this one. Now, there is another way in which people can own property that seems to address some of these issues we talked about, and that's using something called a cross-border trust. So just give us the highlights on what that solution can look like.
So trusts are extremely popular in the U.S., and there's a gamut of trusts. There's a revocable trust, living trust, land trust, Massachusetts trust. In Canada, we have revocable, irrevocable, bear trust, cross-border trust, family discretionary trust, testamentary trust. We've got them all, right? So trusts are very good, and the reason being is theoretically a trust, when properly drafted, will not die. The piece of paper will not die. The piece of paper will not become incapacitated.
Right.
And so as long as you have somebody with capacity and alive acting as a trustee, the trust will continue on. So the use of U.S. trust for real estate for Americans is massive. And so it's very easy. Most of these trusts are known as grantor trusts. They're revocable trusts. They're like an LLC ignored for tax reasons. So, husband and wife buy a property together. They own it in a trust. They bought it for $1 million. 10 years later, they sell it for $2 million. And next thing you know, they pay $1 million, but in their names alone. So having a trust is a great idea. Going to a U.S. tax attorney or trust and estates attorney for a trust will be great from a U.S. perspective, but the way those trusts are drafted, they're irrevocable trusts from a Canadian perspective. They're what we call in Canada a 75-2 trust, where although the trust is the taxpayer, it all attributes to the beneficiary. But we have a hard stop on the trust being the taxpayer. And again, mismatch. In Canada, in the U.S., Darren is the taxpayer as a beneficiary of the trust. In Canada, the trust is the taxpayer. So many, many moons ago, when we were dealing with probate, and we were doing a lot of Florida probate in the for Canadians, we kind of asked our questions: how do we reverse engineer this entire process and find a solution that helps Canadians? We knew about the U.S. trust, but we also knew they didn't really work in Canada. And so we spent a lot of time figuring out a way that we can match the structures on both sides of the border, meaning completely disregarded trust on both sides of the border so that the beneficiaries are the taxpayers, while giving them enough meat on the bone so that from a U.S. perspective, somebody doesn't raise the hand and says, this is a passive trust and it can't even avoid probate. So it took a lot of drafting by some fantastic experts across the board over years. We won't name them here, but I think that if they watch this podcast, and they should, they'll recognize themselves. Talented people. And it took a lot of work with underwriters across multiple states, Florida, Arizona, California, to make sure that the nature of the trust was preserved as active enough to avoid probate, but passive enough to meet the Canadian guidelines of a bare trust. And we believe that some have the formula, a lot don't. We believe ours does meet the thresholds of bare trust in Canada because of the way we detail the transfer after passing. But a cross-border trust, in theory, will avoid probate, will avoid incapacity, will preserve foreign tax credits on both sides of the border, will provide to have mechanisms of distribution by separate testamentary instrument, so that when the parents are no longer around, that property could pass on to the children without causing too much chaos on the U.S. side. The tax rules remain the same on both sides of the border, and it gives peace of mind. There's a little bit of a caveat this year with the new CRA requirements for T3s even on bare trust and even on non-income producing properties. But I think it's just a little bump on the road when you consider the type of headache and chaos that could be caused, especially if somebody's passed away. And for maybe a future conversation between you and me, a lot of people sitting by the pool will hear about adding their kids onto title so that they can create some sort of a legacy, ownership, a legacy, as we may call it. It raises a slew of other problems that we can discuss on future opportunities.
Yeah, we see people try that in Canada with cottages, right? They've got the cottage in Muskoka or whatever on the lake, and they think, I'll leave it to my kids. And that creates a whole lot of complications doing that. You begin doing it with property in another jurisdiction, and you just made it even more tangly, as my friend from Newfoundland says.
And even in Canada, you want to set up your cottage in a Muskoka as an alter ego trust or a joint partner trust, and you got to look at ramifications, right? Alter ego trust, you got to be over the age of 65. Do I have transfer taxes? You look at the joint partner trust, great way to avoid probate, but on the way into the trust, you've got land transfer taxes in Ontario. Well, what's more expensive, right? And you and I have worked together, and I think that one of the things I like to keep my focus on is the cost effectiveness. Do we want to go into these massive structures to save $2? And our clients typically are generational, right? We start with the parents and we settle the parents' estate, and we get to the kids and we plan for the kids. And, if we live long enough, we'll settle the kids' estates as well. So we're not interested in making the money. We all want to make money, but we're focused on what's right for the family.
Yeah, we need to know what's the size of the problem to know what the size of the solution should be, right?
That's right. You don't want to put a $30,000 solution and another $7,500 of upkeep a year, knowing that, and you'll live 20 years, knowing that you have a potential $200,000 risk, and here I am. Over 20 years, you spent $150 on upkeep and another $30 on the structure. And for 20 grand, was it worth it? No, because it's an if, right? The risks are if, where it's a certainty once we structure. So, like your firm and your practice, we like to be practical. We love thinking outside the box. But we make sure that the size of the solution fits the size of the problem, not the other way around.
Yeah, and what we do, and I know you do this too, is that first step is just getting clarity on what are all the moving parts and where is everybody. And it was, as you were talking about, the Canadian entity, right? I've got the property in Muskoka, and there's trust to create in Canada potentially. One of the things we encounter was, and we've seen this, the attorneys and the client, they create a strategy, and then we go, wait a second, but that person married an American, so does it work anymore? And people don't realize how complicated this gets so quickly. So understanding where is everybody, what's their status, what's their tax status, and how mobility might fit into this, right? Because we also see people set something up and then, well, that kid just moved to Massachusetts. Now, does it still work?
Right. And there's so many things that come into play. And typically, because of fees and because of concerns, the clients kind of work in compartments, right, in silos. So I'll speak to Darren, but I'll make sure that my other financial advisor doesn't know, or my lawyer doesn't know, or my accountant doesn't know. And I say, scratch that. We want to speak to everybody. Yeah, right. We want to know. We want to speak to everybody because we want a holistic kind of solution that works for everybody. And like you said, I see it all the time. They did something, but they didn't consider X, or they didn't consider Y, and nobody thought about it. And then you're the bearer of that bad news that their lawyer didn't consider that, and their accountant didn't consider that, and then you feel like you're sitting there, you're uncomfortable. So, and then you say to the client, you sugarcoat it to the client, but he goes right off on the accountant so it's good. I'm very collegial. I know your team is as well, and our team is. We love the more the merrier, and the more info and the more data we get on the situation and the how and the why things were done, the easier it is for us to fix it. And as you mentioned, there's so many kind of detours that happen during life. And so the planning has to remain dynamic. Whatever, if you're planning in a static way, then you're doomed for fees on left, right, and center. You got to keep everything open-ended. You got to be dynamic.
Yeah, and that's the other thing. It never stays the same, right? They keep changing the tax code, or a family member changes. So this has been really good. So I'm glad we spent a bit of time today. Thank you on what are some of the considerations for people who are buying or owning U.S. properties, Canadians. We're going to have a number of conversations, you and I, because this is such a deep, target-rich environment for us, and we've worked on so many interesting files and situations together. One thing just to share with the listeners is you also have an interesting specialty of working with professional athletes. You guys in Montreal have this crummy hockey team. I can say that because we in Toronto have this crummy hockey team that doesn't want to win anything. And you deal with a lot of players. So I think we can talk a bit about consideration for professional athletes and how that might be different than the average person. We could also talk about, and I went through, this, we have a son that went to play sports in the United States at a very high level. And if he'd gone pro, so maybe not someone who's an athlete, but maybe someone who might become professional athlete. What does that do in terms of the family's planning? So there's a lot of stuff to talk about.
And the same applying with any regular education. We see on a regular basis, kids moving to the U.S. for an undergrad. Next thing you know, they got into med school. They're now practicing. They're not coming back. So mom and dad's entire planning needs to be refocused around that. Professional athletes is a different beast because of various jurisdictions. We're working with a few now that play in Canada, own in the U.S., but they're Russians.
Yeah.
right? So,
Right.
like you've got three balls up in the air and you're trying to make sure the client can catch all three off the bounce, right? So there's the Canadian, there's the U.S., there's their home, who are the beneficiaries. Unfortunately, with everything going in the world, we've got restrictions. So imagine you have a professional athlete that has all these assets, and God forbid the worst happens, and his only two beneficiaries are his mom and his sister living in Moscow. And you've got all these restrictions on transfer of assets, and like, what do we do, right? So these are little things, little challenges we've been working with now. And this cross-border world where a Canadian hockey player moves to play in Washington or Pittsburgh and marries an American girl, and they start having kids, and they spend their winters in the U.S. and their summers in Canada. And are the kids American, or are the kids U.S. Canadian, and do we get their citizen? Like it just opens up to all kinds of questions.
And the athletes kind of are fun because there's a bit of celebrity around it, but that same level of complexity applies to people that are executives, business people. I moved, everything got tangled up. So there's a lot for us to talk about, Shlomi. So thank you for your time today. Pleasure to see you. And for the viewers and the listeners, thank you for listening, for watching. We'll be back to you with some more great information for cross-border situations coming up again. So thank you for your time.
Thank you.
This has been Two-Way Traffic with Darren Coleman of Portage Cross-Border Wealth Management. Thanks for watching and listening. If you have any questions or comments or ideas for new episodes, send us an email at twowaypodcast@gmail.com. And you can find the Two-Way Traffic podcast on Facebook and Twitter. This series is a production of the Acme Podcasting Company.
On behalf of the Two-Way Traffic Podcast and Portage Wealth of Raymond James, thank you for listening to this conversation. This podcast has been prepared by and expressed the opinions of Darren Coleman and his guests, and are not necessarily the opinions of Raymond James Ltd. Statistics, data, and other information presented are from sources Raymond James believes to be reliable, but their accuracy cannot be guaranteed. This podcast is for information purposes only and is not construed as an offer or solicitation for the sale or purchase of securities. Investors considering any investment should consult with their investment advisor to ensure that it is suitable for the investor's circumstances and risk tolerance before making any investment decision. Past performance is no guarantee of future results. Information provided in this podcast is general in nature and should not be construed as providing legal, accounting, and/or tax advice. Should viewers have any specific questions or issues in these areas, please consult your legal, tax, and/or accounting advisor. Raymond James Ltd. is a member of the Canadian Investor Protection Fund. Raymond James USA Ltd. is a member of FINRA and SIPC. Raymond James Ltd. and Raymond James USA Ltd. financial advisors may only transact businesses in provinces and/or states where they're registered.